Why does Bitcoin pump when the Fed prints? And why does it dump when it doesn't? It's not magic, it's liquidity. More specifically, it's known as the M2 money supply. And the central bank policies that drive it, such as quantitative easing or quantitative tightening. These are called QE and QT respectively. And these are the hidden levers behind every major market move. When central banks inject money into the system, liquidity rises, interest rates fall, and capital, money, ends up flowing and finding its way into crypto. When they tighten, the reverse happens, and markets feel it fast. So over the past few years, Bitcoin has consistently followed closely behind the M2 money supply's movement, often with a 70-day lag or 70 days after. And right now, the M2 money supply, as I've covered in past videos, is starting to signal a pump, a rise in its price action. So in today's video, I thought we would break down what is quantitative easing and tightening, and why and how it's so important to understand and track the global M2 money supply in order to know the effect it's going to have on Bitcoin and your investments. So if you're serious about managing your investments, this video is for you. So let's get started with today's content. Okay, so we're going to start off by checking out a proper official site recognized as an authority and reputable source for tracking the global money supply, the M2 money supply. And that would be here, fred.stlouisfed.org. This is where you can see how often they update the global money supply. You can see it's on a monthly basis. You can also see when they updated it, the chart in real time, and what is the global money supply composed of, right? So you can see here that it consists of savings deposits, small denomination time deposits, less individual retirement accounts like IRAs, et cetera, balances in retail money, market funds, MMFs, etc. So this is where you would go if you're interested on your own to be tracking it, and just star the page up top. And that way you can always go check it out to see where we are yourself. Next, we're going to run through a few key posts that I found on X that explain once again our correlation between Bitcoin, the crypto market, subsequently behind it, since the crypto market follows Bitcoin's price action, and as it relates to the global money supply. So here, as shared by OX Pen on X, they say, after a steep drop in January, right here, the M2 money supply growth seems like it is once again picking back up. You can see how the chart is starting to go back up, right? So they say, what is the M2 money supply? Simply put, it measures how much liquid money is in circulation in the market. More liquidity, more cash, people feel richer. It leads people to spending more. And that spending trickles into risk assets or hedging assets like gold or its counterpart, digital gold, Bitcoin. And then moving on, shared here by AUAG funds, they basically explain that what I've been saying, right? A rising M2 curve, as I highlighted on the screen, is an indicator that the printing press, right, quantitative easing, when there's more liquidity in the market, that the printing press have come to life and monetary inflation is picking up again. So you can see that here in the chart. And as Nick, the CEO and co-founder at Coin Bureau, shares with us, there is, as I highlighted on the screen, a 94% correlation with Bitcoin following the global M2 money supply. And you can see that here yourself. So what is in blue is the global money supply, and the black line is BTC's price. So you can see how there is definitely a correlation, a big correlation. So isn't that interesting? And here, as shared by Joe Consorti on X, they pointed out, right? It's either a 10-day or a 70-day lag or delay between Bitcoin and the global money supply. But let's break it down. So, what is quantitative easing? There is a great resource called Investopedia if you're not already familiar, and you can search all sorts of investing terms there. So here I looked up for you quantitative easing, QE, what it is and how it works. So quantitative easing is a form of monetary policy in which a central bank like the US Federal Reserve purchases securities in the open market to reduce interest rates and increase the money supply. Quantitative easing creates new bank reserves, providing, this is what you need to remember from all of this, providing banks with more liquidity, more money to lend its clients, right? So people go get business loans and then they, go invest that money. So it encourages lending and investing. So that's how they promote the business. That's how they instigate and promote people to do business in the market. So isn't that interesting? Key takeaways. Quantitative easing is a form of monetary policy. It's used to increase domestic money supply and spur economic activity. And mind you, all the countries of the world do this as well. So with QE, the central bank purchases government bonds and other financial instruments such as mortgage-backed securities. And quantitative easing is typically implemented when interest rates are near zero and economic growth is stalled. So this is why you have Jerome Powell coming out every so often giving updates on how the interest rates, on what the interest rates are going to be or how much they're going to drop them by. And that's why he comes out and evaluates market conditions, right? And everyone's always hoping for quantitative easing because it basically just means a bit of a bull run's coming. Every time historically there's been quantitative easing, they've been started printing money, the market picks up. So it's quite long and extensive here. You can go read more about it on your own, but that's essentially what quantitative easing is. So some key takeaways is it boosts the global money supply, it lowers rates, it creates a risk-on environment where investors pile into assets like stocks, crypto and commodities. And it basically, it just makes borrowing cheaper. So on the other hand, let's go check out what is quantitative tightening. So you can go also search for it here at Investopedia, but I just took a few quick notes for you. And basically, it's the exact opposite. It's when the Fed sells off its bonds or lets them mature without replacing them. So that pulls liquidity, it pulls money out of the system, it shrinks the empty money supply, and it ends up raising interest rates. So it discourages people from doing business. So anyway, let us break down though. Let us look a little into what is behind letting bonds mature, right? That's a question I had as well. So when bonds typically mature, the issuer, like the US Treasury, usually pays the face value of the bond back to the bondholder, right? In this case, the Fed. But here's what actually happens. The Treasury pays the Fed the bond's face value from its account at the Fed. This payment reduces the reserves held by a commercial bank at the Fed because the Treasury draws from its account to make the payment. The Fed does not reinvest this money into new bonds, and it effectively shrinks its balance sheet. So when this happens, commercial banks' reserves at the Fed decrease since the Treasury's payment to the Fed reduces the total reserve in the banking system. And as these reserves decline, banks have less money to lend out, leading to reduced lending and money creation. Isn't that interesting? So why doesn't the money recirculate, you would ask? Well, since the Fed is not buying new bonds with the repaid money, it doesn't go back into the economy. Instead, it's just disappearing from circulation, effectively reducing the money supply. So that is how quantitative easing and quantitative tightening work and the effects they have on the market and what's happening behind the scenes. And then we have here Aluai Capital sharing a glimpse of what recently happened in the crypto market. When ETH was pumping this cycle, it was because of Bitcoin and not because of quantitative easing, right? Because we know we have been in a quantitative tightening phase. And Bitcoin pumped in large part due to Trump's inauguration and, all the promises he made in his campaign, such as the Bitcoin Strategic Reserve, which we're still waiting to hear updates from. And that is basically what pumped Bitcoin's market and the introduction of Bitcoin's historic first ever ETF. So that is what caused Ethereum to pump this cycle. And we know that on April 1st, so that was just 2 days ago, 2 or 3 days ago, depending on when you see this video, that Jerome Powell said he was going to be loosening up or stopping, basically chilling out on their quantitative tightening, because we've been in that phase right now. So while it's not quantitative easing yet, it's not the printing of money, they are slowing down at least on removing money from circulation, what I was talking about a moment ago. So essentially, the Treasury redemptions will they dropped officially now, from 25 billion to 5 billion. So exactly. So while it's not full-blown quantitative easing yet, it's a pivot towards it. It's at least we're moving in that direction now. And this will be fantastic for risk-on assets like Bitcoin, of course. So that's where we are in this moment in time. So now in terms of some speculation, which is based on patterns, right? And Bitcoin's past behavior in regards to the global money supply, you would see that as shared here by Niels on X, that the M2 money supply, the global money supply, has reached a new all-time high historically. And every time this has happened, Bitcoin has made a new high within 8 to 12 weeks. Just remember that, 8 to 12 weeks. So he's saying that he thinks the possibility of Bitcoin reaching a new all-time high will be by April or May, and that probability is quite high, right? That's right. So, everyone is very focused, on this whole tariff conversation that's happening globally and worried that this cycle looks different to past cycles, which is fair, but also we've had other conditions that have been so different this bull run as well. So many people are just too stuck on like the immediate technical analysis of what's going on, and they're not zooming out. Remember, when you're in doubt, you're supposed to zoom out and look at the big picture. And one of the biggest macro indicators that both traditional markets and the crypto market, Bitcoin, follow and respond and react to is the global money supply. So that's what we have being shared here by Crypto K Dud on X. And they say it, it's insane how well the global M2 money supply correlates with the total market cap in crypto. So if you followed the total market cap in crypto and its correlation with the global M2 money supply over the past 2 years, you would have nailed the bottom of the market, nailed last year's March local top. You would have nailed September's local bottom, and you would have nailed December's local top. So look where we are now. Right. So, guys, I hope you have a better idea of what quantitative easing is versus quantitative tightening and the impact they have on the crypto market and Bitcoin specifically, and how long the effect takes to take into effect. And it's usually between 8 to 12 weeks or 70 days. And as of right now, the global money supply is already starting to spike up. So that means Bitcoin is not far behind, and we'll have to see what April and May look like, right? So, all right, guys, that is a wrap for this week's content. I will be back here on Monday. Let's see what the weekend brings. But, in the meantime, we're not worried. We believe in Bitcoin. We hold Bitcoin. We're not worried about temporary conditions of market, not unless you're invested in, bad crypto tokens and bad meme coins, in which case it's not too late to pull that money out and put it into real blue chip tokens, or just take the money out and just wait until there's a better opportunity later on in the bull run. So it's not financial advice, but this is what I would tell my mom. But okay, guys, so love you very much, and I'll catch you guys here on Monday. Bye.